You mentioned the shift back to fixed rates in there. So how much of a shift has there been?
Yeah, not massive. So I think we are seeing a small shift, but it's not a massive shift. So overall you're still seeing 60% on variable and 40% on fixed. Some of the fixed rates obviously relate to people who took out longer term fixed rates some time ago, and then we're seeing a little bit more of a shift more recently in some of our growth with some of those promotions and specials you've seen, both from existing customers and new customers coming on board who've taken advantage of what are relatively, by long-term trends, low fixed rates. So you've seen some of that coming in, which is affecting the numbers slightly, but it's not material at this point. So it's not sort of taking off or anything. We're just seeing gradual movement.
Sure, and people on those floating rates are using it to pay down debt quicker. Obviously, that can't go on for Kiwibank forever, or else you have no customers. Where are you seeing the customer growth?
Yeah, look, I think it's people paying back debt. There's a couple of things at play there. One is that people are paying back a bit more debt. The other is the fact that we're now 10 years old, so some of our mortgage book will be amortising a little bit faster. Yeah.
Okay, right, but you're getting your customers, the majority of your new customers, from other banks.
Pretty much,
right?
Yep. So normally what you would see is if there was a lot of new activity in the market, you would see a higher share of the new customers, if you like, particularly on the mortgage side, coming from the new activity in the market. Because we're not seeing as much new activity in the market, there's not as much business coming from that. So to answer your question, absolutely, we are seeing business coming from people who are looking to change banks.
And in terms of those people, you mentioned you've got a lot of lower LVR lending going on at the moment. Are most of those people that you're pinching in that area, or is it across the board?
It's across the board, but there's quite a significant focus, if you like, in that lower LVR area, and you might have seen some of the specials, for example, are focused on the lower LVR space, targeting that good business.
So there's the special mortgages.
Yeah, I think it was less than 70% LVR.
Okay, what about paying break fees?
Oh, we don't get into all that, but at the end of the day, obviously...
You don't do that? Or?
Well, at the end of the day, we're negotiating with customers, and we'll deal with them on a case-by-case basis.
Okay, sure. Now, there's talk about the need for the capital injection from the government,
sure,
possibly over the next few years. So you can't get that all from retained earnings. The sort of the $200 million.
Well, I think the rules are going to change faster than that. So what you're going to see is the requirement for capital will be quite large relatively soon, and that's because of the change in the global rules that we're seeing around the regulation. So bottom line is that requirement is happening, over the next few years, 3 or 4 years. So you will see a stronger requirement. I don't think it all can come from retained earnings. There'll be an element of that, but if we continue to grow it the way we're growing, we've got to have a mixture of both. And clearly, we're in discussions with the shareholder on what both our growth plans are, and also what the requirements might be for the regulatory capital.
How much capital also do you need for the bank assurance startup?
Well, it's relatively small on the bank assurance sort of side of things. There's a little bit of capital needed in a few other areas, like continuing to invest in our systems and people and process and technology as we grow the bank, as it becomes bigger and is dealing with a larger scale customer base. And some of those other investments are important from managing the risks within the bank, but also important in terms of overall continuing to sort of flatten the cost base, if you like, over time as well.
Cool. And what's the outlook for any more covered bond issuance from Kiwibank?
Look, well, for covered bonds, we're looking at it, and it's certainly another one of the funding tools available for banks. Again, it depends on market conditions and also the level of growth as to whether we need it.
Right, and you talk about having an 83% funding
customer
through
funding, yeah.
Customer deposits. Are you wanting to keep it at that level, 80%, or are you happy for it to be diluted a bit more?
Yeah, I think overall, on the long term, if you look over the long term, it could be diluted a little bit. But overall, we see sort of having a strong customer funding ratio is really, really important, because it gives you that flexibility to stand in the cycles. So that's quite important, firstly. But I think we are happy to see it come back a little bit. But
how about 5%?
I wouldn't give the overall numbers. I think overall we're happy to see it come back a bit. But having a strong customer funding ratio is a really important dimension.
Okay, and what's the outlook for the next year in terms of the housing market, do you think? What are you seeing in Auckland? It's obviously gone up.
Yeah.
Will it taper off?
Look, I'm not an economist, but I think we're seeing all sorts of things going on, and I think if you take the Auckland scenario, I think what we've been seeing is largely a supply story. And so we're seeing a lot of activity around restricted supply. If the supply opens up a bit, you might see that come off slightly. But again, that's kind of what we're seeing in Auckland. If you go to Christchurch, for example, I think the longer term, over the medium term, we'll start to see more activity down there. And that's largely as the rebuild gets underway.
So more houses are built.
That's exactly right. And we want to be right there supporting people to make sure we can help that happen.
Okay, whereas in Auckland, can you see prices going much higher there?
Well, I don't want to predict property prices because you always get it wrong, and generally both bankers and economists get that wrong. So who knows? Again, it's something we watch closely. We have our internal views on it, but I don't want to go sort of disclosing what I think it might happen. I don't think predictions are a wonderful tool. My view at the moment is we're in a relatively flat environment, and that will continue for some time.